Welcome, everybody. Welcome to Peak Market Watch. We're here with Anton Matley and myself, Cedric. And today we're going to start the discussion with when we rewind the clock to early September. You made a number of predictions, really about how the pending rate cuts, which we've now seen two of, how they were going to impact financing for the long term in multifamily, commercial in general. And your predictions stated, which was contrary to everyone else, that the long term financing rates wouldn't come down. Fast forward to today, they haven't come down. So maybe you can demystify the thought process of that for everybody listening.
Yeah, so I think what we have seen, unfortunately, over the last few years, a lot of new investors coming into the commercial real estate space. And everyone, after interest rates moved up significantly, everyone was hoping, okay, now the Fed is going to cut rates. And with that, the interest rates will come down. And equally important, cap rates come down, meaning valuations will go up. What no one is realizing is in that world is that the Fed has control over the short term, the Fed rate, and with that, the SOFR, which then applies to bridge loans and construction loans, floating rate loans, that index rate will come down. However, when it comes to the longer end of the yield curve, like 5, 7, and 10-year and longer yield curve, there is not really any influence.
And you
there.
always joke that you don't have a crystal ball, especially when you speak on stage. But this is one of those occasions where you definitely did have a crystal ball in this situation, and you're able to predict it, right? Because the long-term financing rate didn't come down, and that's really having to do with the spread, right?
Yes.
Maybe you can explain that a bit.
Yeah, so it's what is important to understand is right. We had an inverted yield curve now for a very long time, and at some point the yield curve is going to adjust again, where the longer end of the yield curve is higher than the short end of the curve, and it's now just happening. We are in the process where the short end will likely come down more with the additional cuts, but the longer end is not going to come down in the same fashion. Now, when some of you who follow us, we have shown a chart in early September where we showed the short-term end comes down and the 5, 7, and 10-year yields on the treasury yields, they will stay flat at best and possibly go up. And as we know now, we are 50 basis points.
You talk a lot about short and long term of the curve with the yield curves. Maybe you can break that down. I think a lot of people at home, they're hearing short, long, they're a little confused. Maybe also how that's applicable to what loan products, short and long, how it correlates, right? Maybe you can get into that a little bit. Start with short term, right?
Yes. So again, the short end, really, when we talk about what the Fed has control over, is the Fed rate. Nothing else they really have control over. And the closer you are to the Fed rate on the yield curve, the closer it's tracking what the Fed rate and the Fed are doing. When it comes to the longer end, 5, 7, 10-year, and even 15, 30-year, there is not really any element there where the Fed or the Treasury have control, unless they implement, like Japan has done it, a so-called yield curve control or yield spread control. The problem is then they need to start buying or selling a massive amount of Treasury bonds, which the US government hasn't done. They may do it, but so far they haven't done it. And because they haven't done it, the market completely decides where 1 year, 2 year, 3 year, 4 year, 5 year, all the way to 30 years the yield should be.
Yeah, and I guess for syndicators watching, LPs watching, they need to keep in mind that these short-term rates impact things like SOFR, so that would be bridge debt, short-term debt, any sort of, hard money, that sort of stuff. While when we start talking about agency, even FHA, HUD, if you're into that, any sort of long-term conventional debt, it's going to be that long end of the yield curve. So that's really important for people to get through their head, I think,
That's
really.
right. That's all the permanent financing is mostly driven by indexes that are 5 to 10 years, right? And that's where
Exactly, yeah.
the treasury yield has not cooperated. And obviously, the hope that many people have had has not come to
Yeah.
fruition. And I do not really foresee that's going to happen next
That's
year.
yeah, that sounds really accurate. I know this is a bit of a dry topic for some people, but we're going to move on to something a little bit more juicy, a little bit more interesting. We've been seeing a very serious struggle over the last year and a half in commercial real estate, certainly on the acquisition side, also from asset management, returns maybe not being where they are projected to be. It's been a struggle. So, what would you say is on the horizon in 2025 for multifamily, both from an acquisition perspective, and then we can talk about existing deals maybe as well.
Yes. So as the rates moved up, right, and particularly again when we look at the 5, 7, and 10 year, especially the 10 year Treasury yield moved up so significantly, uh, the cap rate for all these properties also moved up, meaning the valuations, generally speaking, have come down, right? And when we look at multifamily, most syndicators are active in multifamily. Yes, there are some self storage and some other
For
commercial
sure.
real estate, but the majority are in
Yeah.
multifamily. And the reality there is that values generally have come down 20, in some markets 30% plus.
Wow.
And naturally, if you do not have to sell in that environment, you are not selling, right?
Exactly.
And
Yeah.
that's why all what you see really that has come to the market over the last year and a half to 2 years was only from forced sellers that have to
Hmm.
sell. Everyone else tries to refinance if they can, or they hold on to the property if there is no capital event, whether it's refinancing need or a sales need. So that reduced the
Yeah.
volume of transactions coming to the market significantly.
So we're seeing, kind of to tie it back to the first topic, we're not seeing a cut in the actual permanent financing, long-term financing. So we're going to start seeing more of these distressed owners who can't refinance out, taking that 30% hit, whatever that number looks like. What do you think?
Yes, so obviously it depends a lot on what type of financing you have on your book, right? So when you look at Fannie and Freddie,
Okay.
uh, the loan book, there is very little distress in the on that book because obviously they are not bridge loans; they are mostly permanent financing with fixed rate loans. They have some floating rate, but the majority is fixed rate loans. So as a result, the main distress really is in construction loans and
Oh,
bridge
wow.
loans,
Yeah.
right? And those are that will struggle next year too. We have seen a lot of loan modifications, right? We have talked about the wall of debt that is hitting us in
Mm-hmm.
24. It didn't really appear that
Mm-hmm.
strong because a lot of lenders were willing to do the loan
Okay, so you're
modifications.
saying the reason we talked about that impending, everyone in the news was talking about that wall of debt. So the reason we didn't see that happen is because it was just being extended by lenders. Is that the answer?
That's right. A lot of the distressed loans have been extended. My prediction is that those lenders are getting tired of the situation
Wow. Yeah.
where property performance in most of these deals hasn't really improved. The deal sponsors, they do not have their own money, so they have to go back and raise more money from their investors. Most investors are tired of having to fund through a capital call,
Exactly.
and
Yeah.
so everyone has kind of that deal fatigue, and
Mm.
eventually they say, look, we now need a solution here. We hope that you were able to fix it over the last year. You didn't, and interest rates are still high, so now we need a solution here. And I
Okay.
think that will trigger more foreclosures or structured foreclosures where the lender already
Mm.
has some form of a buyer in the
Yeah.
back pocket, and then also sellers that just have to
Yeah.
turn the keys back because they
So we're
run
not
out of
talking
time.
about necessarily like a full blown 2008 recession environment for that to happen. This could be kept a little bit even more quiet and it just kind of unravels, right? It doesn't have to be big in the news, I guess is what you're saying.
Yes, it's unless you have a black swan event, right? And
For
we
sure.
saw
Yeah.
we have talked about the office space quite a bit. There is still a risk that we have a lot of the
Yeah.
bank portfolio, loan portfolio in distress that hasn't been properly recorded yet, where
Mm.
potentially, if there is a significant distress on the office side, that we might also have a
Yeah.
contagion that is spreading
Yeah.
wider.
So,
But
yeah.
assuming that that is not the case, then it will be primarily the distress really be just limited to the maturing bridge loans and construction
Yeah.
loans.
So, what do you mean by that properly recorded black swan event? Just so we can get some better ideas there.
Yes, so unfortunately, right, so the banks are not necessarily, as long as someone is still paying their loan, debt
Okay.
service, they are not really recording that as a distressed asset.
Wow.
uh, the loan to value, they are not revaluing these values of these properties on a regular basis. So even though values have come down, obviously on the office side, it's the most extreme where we have seen
Mm.
values drop by 80, 90%. But even on multifamily, they have not adjusted the loan to value
Wow.
down by 20%. So based on their book, it's still a performing loan. But if it had to be refinanced today, they would likely
They couldn't refinance.
potentially not refinance, or it would be a struggle to refinance out
Wow.
of it.
So we're talking about multifamily, not just office and new construction that's also really struggling and
Yes,
potentially underwater.
yes, definitely. Construction loans, bridge loans, it's a significant portfolio, right? We know securitized bridge loans, we talk about 60 to 80 billion. So now, in the scheme of everything from multifamily, where you have roughly 2 trillion outstanding, it
Wow.
doesn't seem to be such a big amount. However, it's still very significant, particularly when we look at the Class C space, where
Mm-hmm.
most of these deals are. It's B, B minus, and Class C. So when we just focus on that space, I think there is quite a bit of distress in that particular segment of
Okay.
multifamily.
Well, that certainly creates a lot of opportunities for the people watching that maybe they have the capital to deploy. Um, Talking about that, because we do hear a lot about people that are on the sidelines looking for those opportunities. I guess maybe talk about how they can get themselves prepared. But really, what I want to talk about is we see a lot of people who maybe were in multifamily 2 years ago when it was the hot thing to invest in. Now they're online pushing other alternatives that are more attractive from a tax perspective. For example, oil and gas, old businesses, stuff that has heavy equipment, that tax depreciation element. So, what do you think is causing that shift?
Yeah, so everyone is chasing, very often, not everyone, but many are chasing the shiny object. And obviously, there is no dispute. Multifamily and commercial real estate, with the rate increases that we have seen since the middle of 22, has been struggling. So we get that, right?
For sure.
The problem is that everyone points, oh, multifamily is struggling, multifamily is bad. Here is a shiny object that is
Mm.
much better, right? So that is what really has driven a lot of newer multifamily syndicators, those that have been in the business for a long time. They are not switching because they know there are phases and cycles. But the newer ones, they suddenly switched over to completely new asset classes they have no idea about, and or peddling those. And the problem is that virtually none of these syndicators, they have had very limited experience in multifamily, and now they have even less experience in these asset
Yeah.
classes, and think that they can beat the experienced operators in that
Yeah.
space, which is extremely difficult to do. And as we have seen also with in a number of cases, because it's even less transparent than a real estate transaction. With real estate, at least you have
Why
a
do you say
deed.
that?
You have a deed
Okay.
of trust, right? So you actually can validate that you actually own a property as an investor,
Right.
right?
Yeah.
When it comes to businesses and oil and gas, it's much harder. Yes, you have oil production records, but you do not know whether the operator has been selling that same production to multiple investors, and you would
Wow.
never know. And as you know, we have some other segments where there have been a lot of issues, including fraud of some of these niche offerings, where
Hmm.
they also didn't do the due diligence, frankly speaking. Right?
Yeah.
There's these so-called fund managers. They did not even basic due diligence and ongoing asset management. That's why these fraud cases even
Yeah.
could take place.
So, from a limited partner's perspective, an investor, how should they look at oil and gas, ATMs, other alternatives? How can they look at that since it's no longer real estate with the deed? How should they look at that and create that vouching, that validation that they're getting what they're paying for?
Yeah. So it's we have invested in oil and gas, and the only way I would suggest to invest in oil and gas is invest with someone where you have very deep, long-standing relationships, and you really understand the underlying business, where you have the ability to actually check the finances, that the finances are audited, and if you do not have that knowledge, in basic knowledge, I would say it's probably a high risk proposition. I understand, right? One of the reasons why a lot of people were drawn to it, and also why a lot of syndicators have been peddling it,
For
are the
sure.
tax
The
advantages, right?
taxes,
Because you can
exactly.
deduct it from your W 2 income. So that's ideally for doctors and engineers and dentists and all that. When you look at all the individuals that have been the largest percentage of victims of all these frauds are mostly in these three groups, right? And because they have high income, right?
Exactly.
W-2 income, and they have the advantage when these things work well to have significant tax deduction from their W-2 income. The
Exactly.
problem is a lot of these deals now have fallen apart, and if they stuck to multifamily, they would be in a
It would be
much better
safer,
position.
yeah.
Yeah.
Yeah. So, well, what would you say to some of those individuals? They're looking at that big tax bill and they're wondering, well, it looks like it's a risk-free proposition because, it's marketed as you put in your money, it's basically a free investment, and then you get some sort of return, even though it's very risky. Should they just pay the tax bill? Should they roll it into something maybe else that's a bit safer? What would you be your sort of perspective on that?
Yeah, so I would say is if you invest into something just because you to reduce your
Tax
taxes,
liability, yeah.
you shouldn't do it, right? So if you can get the tax advantage and you understand the underlying investment,
Hmm.
go ahead and do it, right? So I'm not against to saving taxes, but only do it when you really understand
Yeah,
the underlying business. Now, obviously, when it comes to long-term investing, the more you invest in real estate and you continue to invest in real estate,
exactly.
you will build up your portfolio, and with that you will have an ongoing, as you turn properties, you will have the ability to continue to take advantage
Exactly.
of depreciation. It's not a short-term approach, it's really a long-term wealth
A long
creation.
game, yeah.
That's right.
And obviously, with real estate, it might not be the most advantageous immediately unless there's a heavy cost segregation plan, value add with a lot of capex, right? But you can also play into the 1031 game and other ways to long run, defer your capital gains tax. And there's other methods there. And probably, I think you would agree, people should be a bit more wary when listening to these tax strategists that are self-proclaimed and maybe don't have the track record to back it up, right?
Yes, I mean you bring up a good point, right? So it's if they didn't lose money for their investors, it would be kind of funny. But
Yeah.
considering that they lost tens of millions, if not
Wow.
hundreds of millions of investors' money to call yourself a tax strategist is really silly. They all know the CPA. They have no education in that field whatsoever. But
Hmm.
somehow investors believe that they are now experts in that field, right? And they always say, well, talk to your CPA. But the CPA will say, yes, you can deduct the taxes, but they are not really vetting the underlying investment, right?
Yeah,
And what does it help when you
that makes
can
sense.
deduct your taxes when you lose all your investment, right?
That's true.
So,
Yeah. Yeah. So I guess kind of round off this discussion a little bit more. Um, what are you listening to? A lot of people kind of ask, well, how can I get educated? I think the first step for a lot of people is just absorbing as much information as possible. So what podcasts do you recommend? What conferences are you going to?
yeah, so what I would suggest is listen to podcasts of people in commercial real estate, including multifamily, as well as coaches in that space that have been around for more than just 5 or 7 years, right? Many of
Hmm.
these syndicators and many of the coaches and gurus
Okay.
appeared somewhere around 2015, 2013, 14, 15, which was really driven by the Jobs Act that made it easier to do syndications. Anyone who was not around before the GFC, I would be wary of as a coach, as well as someone I would listen to when it comes to investment advice and strategy for
Hmm.
commercial real estate. Right? There are always some that are really smart, but the reality is, time in that business will make you smarter
For sure.
about your judgments. And so when it comes to like when we listen, for example, to Kenny McElroy, right?
Hmm.
So he
Exactly.
puts out a lot of content. Now you may not agree with everything that he is saying, but always remember that he has been around for a long time,
Oh,
right?
for
So
sure.
now
Yeah.
when it comes to the coaches, right? There are some that have been around already doing the GFC and have gone through that. I would trust those coaches much more
Hmm.
than
Yeah.
those that just appeared because there was a honey train that everyone
Yeah.
was jumping
So
on.
what would you say then, you're hearing that you got to be someone that has that long track record, but maybe you're young or you're just getting into this, you've done some single family and you're trying to get into this space from a general partner side, buying some multifamily. What is your strategy there since you don't have that track record? How do you get into this space? Because you have to start somewhere.
Yes, it's a good question, and it's a challenge for everyone, right? When you start out, uh, the advantage for commercial real estate is unlike on the single family where you are a lone warrior that does his or her own deal. You partner up with others, so you can seek out team members that have the experience, that have the financial strength, that are able to put together a team to actually do deals. And obviously, you need to bring something to the table, right? If you are an experienced person, you may not say, well, okay, so someone comes and wants to partner with me, but what does the person bring to
For
the
sure.
table? Obviously, you have to think, what are your strengths? Is either it's financial skills, maybe it's selling skills, maybe it's asset management, right? That you
Hmm.
may bring already from the single family side. There are a lot of skills that someone may have but needs to actually write down, think, these are my skills, and present them to
Yeah.
potential partners. We see it all the time. 2025, in my view, will be the year where partnering up with the strongest will make deals successful.
Hmm.
And there will be a lot of those that still think that they can
Do it
just do it
themselves.
on their own and they will not get deals because sellers and brokers, they do not want to take that risk. We have
No.
seen in 2024 a massive amount of deals that brokers were listing fell apart because the team was
No.
too weak,
And
right?
that's another good point. You can't, in a lot of cases, unlike residential, just outbid and win a deal. You have to bring in the strong sponsor team with the track record, the experience, and the money, right? It's not just about if you have the money. You have to bring in that track record, right?
Yes. Obviously, if you come in with 100% cash, no one
For
cares,
sure,
right?
yeah.
But very few do that. And as soon as you have just even a smaller amount of financing, the lender is already determining for you in a way whether you are qualified to actually buy that property. And a lot of deals fell apart because people did not qualify for these
They
loans
can't
from an
close.
experience perspective. And at the same time, a lot of the equity investors didn't trust them, so they
Oh,
weren't able to raise the money,
right.
right?
I mean, that's a
So,
big deal, right? Because you can put in offers, but you can't close.
yeah.
So, new investors trying to get into this, partner up, find those experienced people, track record, both to find a deal as well as learn how a deal is run. How would you tell them if they're saying, okay, I hear that. Now I want to get educated and I want to know what does it mean to find a good mentor, to find a good deal, and they want to come up with an idea about that because they don't have the right baseline, the right basis. Maybe they didn't learn about
Mhm.
finance in school. How can they start getting educated?
Yes. So the first step really is podcast help a lot. Reading books helps a lot, just to get a general understanding of
High
the
level.
space at the high level, and then investigate all the coaching groups. Ask the students in these coaching groups that are actually active what their experience was and has
Mm-hmm.
been in that group, and then make a decision based on that. I believe, obviously, a lot of these coaching groups, they are not cheap.
No.
But if you join the right coaching group, it will give you a massive kickstart because it also allows you to find team members that are already farther ahead
No.
that might be willing to partner up with you.
Exactly. And for the people listening, we don't have a coaching group, so it's not like we're trying to sell you there. But you think joining a coaching group is the right way for someone trying to break into and get that experience on, I guess, really a fast track. You think a coaching group is necessary. It just has to be the right one.
Yes, it has to be absolutely the right one. I think joining a coaching group is absolutely key, but you have to pick the right one. And I only have some of you have heard my opinion about the coaching gurus. Unfortunately, I would say 90% of all the coaches out there
Okay.
are not worth what they are selling. So that is the hard part, right? To find
No.
out who is really the right one. Feel free to reach out to us, and we
No.
certainly can tell you whom we would recommend. We generally do not tell you whom to avoid, even
Right.
though we know who they are.
No.
But also from a liability perspective,
Exactly.
we just
Well,
cannot do
so
that.
what are
Uh,
some vetting questions, general top level vetting questions, someone looking into a coaching program? What should they be thinking
yes.
about?
So I want to see that the coach actually has done deals over a long period of time, including including uh, uh, the GFC or before,
GFC,
right? So it cannot be that someone is again. Many of them appeared in 2015, just around that time period,
2015. Yeah.
and later. Have had not done any multifamily business before. They claim that they have done, but there is no record that they
No
have done it,
record.
right? Because you can say on social media whatever you
So
want, anyhow.
how would you validate that? If they're saying they have a record, but you're now saying, you can
Show me the
prove that.
deals. Show
Show
me the
me the
deals.
exact deals, give track
Identify the
record.
properties that you bought,
And would
right?
they have some sort of documentation, like maybe like a loan document saying that they signed on for a certain, I mean, it's personal information. So I'm curious, like how aggressive can you get as a potential student?
Yeah, so I would not necessarily say that you can say, okay, show me the actual loan documentation, but if they show you the actual property, the address of the property, pictures of the property, what they have done with the property, fortunately, again, with all the public records we have
You can
available, as
find the
well as
deed
paid records like CoStar, you can find out whether that person is actually
for
telling the
real
truth or
and
not.
not just a
That's
poser.
exactly right.
Well, that's good to
Yeah.
know because for a lot of students, I think there's a lot of coaching programs out there that are peddling, pushing stuff that might not be worth the money. So it's important to have the toolkit to evaluate that. And I
Yeah.
don't think everyone knows how to. So that's a good point there. So what about we've been talking about general partners and people getting educated, getting into multifamily, starting that out. What about for limited partners? People who deals are being brought to them, syndicators are coming to them saying, hey, invest in my deal. Hey, I have this oil and gas, I have this ATM, I have this car wash, I have this multifamily property. It's got X, Y, and Z return, this IRR, this cash on cash. It's the best deal you've ever heard. How, as an LP, do you filter through that nonsense?
It's really very similar to everything else that is being thrown at you through social media and ads and emails and everything else, right? When you look at
Okay.
what Wall Street is throwing at you, it's very similar, right? So you have this investment, that investment, you have this fund, you have Bitcoin, you have other coins. You have a massive amount of information that is being thrown at you, and you need to have the ability to filter out 99% of that. And the easiest way of that is that you focus on what you actually want to invest in, right?
Okay.
Before you even listen to anyone peddling, decide for yourself what are your investment
Pick an
strategies.
investment you like.
That's right. And then identify those that are actually serious operator in that field.
With the track record.
That's right.
Where
yes.
they can prove it.
And when it comes to track records are on paper are not really worth enough. So we certainly can go in much more detail in another session about
The right question.
so-called track records. Everyone had a great track record who started out in 2010, 11, and 12, right? A track record doesn't mean anything when the tide rises everyone up. What really matters is how have they done operationally during that time period.
And how would you say, so you hear these returns. I've seen it with oil and gas where they claim online 6% per month, for instance. I've saw that recently on Instagram recently, or X IRR, X cash on cash. How do you know whether they're being honest versus stretching the truth with their pro forma projections, right? Because it's all a future projection. It's not what's happening right now. How are you able to, determine what's real and what's fake?
Yeah, so you cannot really determine that on the surface. What I would say, if it's too good to be true, it's probably likely not happening. And you always have to ask, if you had such great returns, right, where we talk about 50% plus per year, right? And even some that offer 20% plus per year, that's a very high return. If you are able to consistently offer these returns, why do you have to go to strangers? You should have in your own network, you should be easily able to raise all the money you can. If you have the track record proving that you're actually able to do it, right?
Exactly.
Yet they go out on social media and conferences and ask complete strangers to invest with them. Their network should be able to feed them all the money they need because it's apparently so profitable.
So profitable. And they have that tracker. That's what they're claiming. So really to kind of close out this, because we've been talking about a lot of different topics for a while, and it's probably a lot to soak in for some people. The year's ending, in a couple days. We're entering 2025. Maybe closing remarks, last steps for people that are watching you and saying, all right, I'm ready to get in and take action in multifamily. There's going to be these opportunities. We think what should be their mindset? What should be their next steps leaving this year?
Yes. So I would say the most important piece is do not look for deals before you have the team together.
For sure.
We have seen too many people that look for deals, and then they think that they have a deal, and then we ask, okay, so who is your team? Oh, we are working on it. Then you're already too late. The first step is work on setting up your team and come up with a strategy with that team, what you want to target. And once you have that, then you can reach out to brokers who may be able to reach out to us, right, where we can see whether some distressed assets are out there. But definitely setting up that strategy with your team is the absolute key. Before you have that, don't waste your time looking at
For
deals.
sure. And you want to make sure that team has the track record, experience. Someone on that team needs to bring that in addition to ability to raise money, in addition to being able to run a property, right?
Yes,
Asset
yes.
management.
And we are always happy to vet the team, right? Where we tell them from a financing perspective whether they would actually qualify for that type of asset and asset size in that market, right? A lot of people feel, well, we can figure that out later and we can bring on another key principal or a guarantor. Technically, you can, but that's not the way.
That's plan
B. Yeah, it's just not the way you should work it. And very often, as we have seen in 2024, a lot of people thought that they could do it, and then the deals fell apart. So my strongest recommendation is don't do it. Set up your team, get the team together so you know that you're able to run once you see a deal.
That's perfect. That makes total sense. All right, but that's enough for today. We're going to have a lot of more topics and discussions rolling out in this new year. Ask your questions in the comments below, whatever platform this is on. We want to hear from you what you want to know, what we can answer for your questions, what your thoughts are from this discussion. And we'll see you in the new year, and we'll see you with more podcasts on their way. Thank you guys for tuning in, and have a happy new year.